Hello, my dear viewers. This is Rakesh Copy Webinars, and you are watching the Forex Trading with Rakesh. Today is 4th of October 2022. I'm your host here. I'm a Rakesh Copy's trading community member. Please do not confuse me as an employee of Rakesh Copy Bank. I am not. Therefore, whatever trading views or trading ideas that I'm going to talk about here are only of my own and they have nothing to do with the bank. Well, in this live stream, we generally do the price action trading, but yesterday, because of lack of time, we could not finish the risk management, which I suppose is the most important part. And so I want to continue it further if my viewers allow it. And we'll also quickly try to go through the charts. Clara is in time here today. Thank you very much for joining the stream. MJ saying hello everyone. Hello MJ. Welcome to the stream, bro. So we know that already everything is already priced into the chart, so we'll not even talk about any fundamentals and we'll stick to the price action and see the key levels. We'll try to draw the key levels for all the things that I see and how we can use those key levels in our trading. That is what we are gonna see, okay, in this. If any of you are new to the technical analysis or the price action trading, you can go through the playlist section where we have two playlists. One is profitable candlestick patterns and the other one is profitable chart patterns playlist. If you go through them, you will understand how the price action works, how the chart patterns work, how single and multiple candlesticks patterns work. As we are going to use those patterns here and there in the trading. So if you go through them, those playlists, you will have a better idea about whatever we talk about here. All right. Now, at the end of the session, I will be taking questions from the viewers if they have any. So please write your questions in the chat and I'll try to answer them all. Lastly, whatever I say in this live stream is only for your information or to enhance your knowledge, okay, so that you can take informed decisions in your trading. So you have to do your own research before you place any trade. Okay, with that said, I want you to go through the risk disclaimer quickly and then we will hop onto the charts. This is the standard risk disclaimer. It says that trading foreign exchange on margin carries a high level of risk. Now, the first thing that comes to my mind after reading this line is trading foreign exchange on margin carries a high level of risk. Now, if I ask you, okay, I'm going to my charts just to show you that how badly the dollar is dropping. This is the dollar index daily chart, how badly the dollar is dropping. But okay, we'll come to this later. But first, my question is, what is actually margin trading? If I ask you, what is the margin trading? Anyone who can tell me what is margin trading? What is the meaning of trading on margin? Now, every time I open this webinar, I say that, yeah, margin trading, forex trading is a margin trading and it is risky. But what is the meaning of margin trading? Who can tell me what is the meaning of margin trading? Anyways, so by margin trading, as I understand this, okay, I want to maybe I can explain you that if you can understand it from that perspective as I have understood it. Margin, okay, what is the dictionary meaning of margin? Let us go into details of everything now. I'm doing it right in front of you, all right? And okay, here I have opened the position calculator. No, what is it? This is baby pips. Okay, I will open Google in this one. All right, google.com, and don't worry, I'm going to show you where is the google.com. This is here. All right, now we are say on google.com, and if I search the meaning, margin, meaning. Okay, what is the meaning of margin? The edge or border of something, an amount by which something is won. Provide with an edge or border, deposit an amount of money with a broker as security for an account or transaction. So this is what we are talking about here. Deposit an amount of money with a broker as security. All right, so you got it. What is margin? Julian Street, sufficient capital to cover your trades. Okay, this is one, and you can use the profit of open positions to gain margin. Julian Street, you are right, very right here. And by the way, welcome to the stream. If you are new, I see that you are new because I know most of my viewers by name. Sufficient capital to cover your trades, that is what MJ is saying. So yes, so if I say, if I state it like this, that whenever you open, okay, first I am trying to answer MGA, sufficient capital to cover your trades. So that means if you are buying, say, a standard lot of USD JPY, so, and if you are opening the trades on margin, that means you have to set aside some part of your capital, okay, some part of your capital to open that trade. That margin is used as the security deposit. Of course, you have deposited with your say broker $10,000 maybe, okay, but to open a standard lot of USD JPY, if it reserves $1,000 from your account out of 10,000, if it reserves $1,000 from your account, let us do it like this now, slowly and steadily. Okay, this trading, say you have deposit equal to $10,000. All right, $10,000. All right, okay, so here it is on your screens, guys. Say you have a deposit of $10,000 and then you open a position USD JPY, which is one standard lot. Now USD JPY one standard lot is equal to 0.1 million, right? So 100,000. So this is the amount USD okay, this is the standard lot, right? Sometimes to open this position, not sometimes, but it depends upon how much leverage you are getting. I'm doing it slowly so that it drills into your head. So you have deposit of $10,000. So if you have $10,000 in your account, you can only open the position of 10,000, right? And one standard lot is 0.1 million, right? So how can you open a position of actually 10 times larger than the deposit that you have in your account? This is happening because your broker is giving you a leverage 1:100, say. Okay, if you have a leverage of 1:100, what does it mean? Anwar Osman, hello everyone. Hello Anwar, welcome to the stream, bro. Do smash that like button. Okay, we are talking about leverage and deposit and margin, everything that is concerned with the risk management. So let us see how the things go here. So say you had a deposit of $10,000, then you wanted to buy a USD JPY position of one standard lot, which is 0.1 million, and you had a leverage of 1:100. My question is that how many of you know how much of the capital out of $10,000, how much out of $10,000 will be set aside to cover this position? Like, we are trying to answer MGA here, where he is saying sufficient capital to cover your trades is called margin, right? So here, from this deposit, the broker keeps $1,000 aside. Okay, margin is equal to $1,000. Margin is equal to $1,000. When I say margin is equal, yes, Anwar is aware of it. So it is very easy and simple. Everybody should know this. So he sets aside $1,000 from your trading capital and call it as margin. When I say margin, it means used margin. You have already used it. Since you have already used this margin, you cannot use it now anywhere else. Slowly and steadily things you will understand, but right now you just understand that you have already used your $1,000 to open a position in USD JPY, or in other words, if I frame it, then this $1,000 is the security deposit for your USD JPY trade. Okay, so this is how I put it. Okay, so your used margin is $1,000, and this $1,000 is the security deposit for your USD JPY trade. Suppose you want to open another trade now. Suppose you want to open another trade of say one lot of GBP USD, maybe not USD CHF. Okay, USD CHF. If you open one standard lot, you again need $1,000. All right, you again need $1,000. So when you use leverage 1:200, your used margin, it takes another $1,000. Control C, Control V. Okay, in this position there will be a used margin. This is a different example. Okay, so here you have USD CHF 1.1 million you wanted to buy, and your used margin is $1,000, but out of your deposit of 10,000, your used margin is 1,000 in this one. So ultimately, how much is the deposit left? Now the entire deposit left is 8,000. All right, so this is your what? This is your remaining balance. This is your used margin on one trade. This is your used margin on one trade, and this is your used margin on the second trade. And as the trade progress in your favor or you're against, it has some profit or loss. And that profit or loss, till the time you have not closed the trade. Okay, first you have to understand that your balance of your account is $10,000, and it will remain always $10,000 till the time your trade is open. But as soon as you close the trade, you realize some profits or some losses. If you have realized some profits, those profits will add into your deposit and bring your balance to a higher level. And if you have incurred some losses and you have realized those losses, then they will be added into your deposit and bring down your deposit. Now intermediate position, there is one intermediate position which is called equity. Now what is equity? What is equity? You need to understand all these terms. Okay, what is equity? It is the remaining margin plus or minus the unrealized profits or losses. I just hope that you understand this one. If you don't, I will explain more. Now, what is equity? Okay, what is equity? Equity, it is the remaining margin plus or minus the unrealized profits or losses. If there are unrealized profits on your account, then it will be added into equity. So sometimes you will realize that if you are in profit, if you have a running trade which is profitable already, then your equity will be bigger than your deposit. Okay, it will be bigger than your balance. Whereas as soon as you close that profit, your equity changes and becomes the balance. All right. Now the problem here is that the broker cannot okay, the broker has some powers. Now you know what is margin call. All right, what is margin call? The margin call is when your unrealized profits or losses are equal to the equity or the amount that you have in your account. If it is equal to that or lower than that, then you receive a margin call. That means that now the margin to keep your positions open are, required margin to keep your position open are more than the amount that you already have into your account. Actually, believe me, something like this should never happen to your account. You should never get a margin call. Therefore, you should not over leverage your account. The essence of telling you everything here is that this only thing that is leverage here, if you use it wisely, then I don't think that you will get any margin call. But the problem is that the newcomers, or say newbies, or the beginners, they don't have any idea about how the leverage works. They only think, okay, I have $1,000, I can buy $1,000,000 or 0.1 million dollar of USD JPY, so it's a good thing for me. But no, friends, it is not. Think from this perspective, which I am going to explain you right now. USD JPY, if it moves in your favor by 50 points, or say 100 points for the ease of calculation, if it moves, it happened many times, leverage made me profitable and later lost the account when I did not know ABC of trading. Lol. Yes, Aju, that is what I'm trying to explain. So for the beginners, it is very easy to just deplete their accounts because they don't know how the margin and leverage works. So margin may be even okay, we can ignore that for some time, but leverage we should never ignore. I must tell you here, if you have a leverage of 1:100 from $1,000, learned a lesson and don't want to repeat it again. Very good. Good for you, Arju. And by the way, welcome to the stream. So broker is saying that I am ready to give you 1:100 leverage. But do you think it is good to trade with the money that is not your own? Don't you think that it is somewhat fishy here? Okay, I will explain this to you. Say you have opened USD JPY thinking that, oh, US dollar is gaining the value, so I should just open buy. And when you open the buy, a 0.1 or a standard lot of USD JPY on the MT4, you have say 100 points of profits. 100 pips profit means price moved in your direction. Okay, let us go slow here. 100 pips profit means price moved in your direction. Now when it is a standard lot, okay, when it is a standard lot, I must explain it now here. So when it is a standard lot, 1 pip is equal to $10, right? Simple. So how much is the 100 pip? Well, Simple calculation. 100 pip is equal to $1,000, right? Yeah, guys, you're with me. So 100 pip is equal to $1,000. Now it is going real slow. I'm trying to get it real slow so that it is drilled into your head. If 1 pip is $10 for every standard lot, that means if it has gone 100 pip in your favor, it has already given you $1,000. Now this $1,000, till the time you have not closed the position, it is called unrealized profits. Okay. This is unrealized profit or the unrealized gain. So 100 pip is equal to $1,000 is the unrealized profit. Now the problem is that the broker allows you to open fresh positions with these unrealized profits. Now when I say it is a problem, you may be thinking, well, broker is allowing me to do something nice. Broker is actually allowing me to buy or open fresh trades, and Rakesh is saying that it is bad. How is it bad? He is actually giving or doing a favor to me. Yes? You think so, Clara? Do you think that the broker is giving you a favor by letting you open the trades with before even realizing these profits? Okay, you will understand why he is not actually, he is trapping you there. So suppose you did not book this profits there. Even brokers sometimes play gambling with us. Okay, maybe, but I will not say gambling. Brokers already know what they're doing. So 100 pip, they have you know that there is no realized profits, because if you have realized this profit, then your account balance will become $11,000 and it will become your part of the balance. But the problem is that it is unrealized profit and the trade is still open, which there is a probability that it can go against you any moment. Now suppose that this trade that you had taken has gone against you, but before that trade went against you, you opened another one lot of USD JPY in the buy direction, thinking, oh, I have got 100 pips of movement in my favor. Oh, that means USD JPY is going to go up and only up. So I will buy another 1.1 million. Okay. So you open another 0.1 million and you get say now 0.2 millions of USD JPY, and you have USD CHF of 0.1 million. So you have three positions open, or I will say two positions open. One is USD CHF of 0.1 million and USD JPY of 0.2 million. So how much is the balance? The balance is still $10,000. On USD JPY you have 100 pips of profit. That means you have now an equity of almost 11,000, and so you open another position thinking that everything is going in my favor, and USD CHF, since they are correlated, they will move alike. Maybe some 100 pips on USD CHF also you are making. But let's not talk about USD CHF for some time and focus only here where you have now two standard lots of the USD JPY. But to your surprise, the USD JPY starts moving against you, all right, and it comes back by 50 points. Now 50 points or 50 pips is equal to how many dollars? It is $500. Okay, $500 if it is one standard lot, right? But since now you have two open positions, or I will say 0.2 millions, so for 50 pip, how much you will lose? $1,000. You understand this? Oh, now I will explain you like this. Suppose you started from here. When the trade goes against me, the broker is back. So no, it's not like that. You think how the statistics is working here. Aju, I want you to focus here on the mathematics. Okay, not on who is bad or who is good. The thing is that it's not broker who is bad. I am trying to explain here is that when we take this decision to open a trade from the unrealized profits, that is bad. So you gained some, say, $1,000. It took some time, right, from here to go here, but it only came the halfway, but your entire profits were gone by the time. Okay, so it just came 50%, it just retraced 50% of the move, and your entire profits were gone because you opened another position thinking that it will go in your way. Of course, if it will go your way, you will have a good profit, of course. But the problem here comes when it comes to the break even. Okay, from where you had opened the first position, when it comes to here, you have an equal loss of $1,000. Why? Because the profits that were made by this position here are almost zero now, zero, and the position that you opened here are now giving you a loss of $1,000. So that means now on your account you have a balance of 10,000 and you have an equity of the remaining margin plus minus the unrealized profits and losses. So here your equity becomes almost 9,000. And when you book them, it becomes your balance. So your balance becomes 9,000. What did you just do? Did you realize what did you do? As a new baby, we don't know how trading works. That's the issue. That's why we are here to learn and know. All right. So, well, this is not that difficult. You just understand that margin is another story, but the leverage is like a two-way sword. Do dhari talwar, Hindi in my language, that is what we call it. So say that if a broker is offering you, say, a leverage of 1:100, 1:200, sometimes they offer 1:500, 400, 1,000, 2,000 these days, you don't blindly take it. You don't really blindly take it. Okay, as a newcomer, as a newbie, I will suggest you do not trade anything more than 1:25. Stick with it and you will know, in the long run you will know why Rakesh told you to stick with 1:25 or even less. Leverage of 1:25 is more than sufficient. And you know, in America, which part of India? So you know, in America, in United States of America, the